What is up, YouTube? What is up, guys? Welcome back to part 2 of the Wyckoff tutorial. Now, if you haven't seen part 1, I highly suggest you skip this video and go back to my YouTube channel, search for Wyckoff tutorial part 1, because part 1 goes over all the basic foundation and the basic rules of market structure, range theory, and Wyckoff. And you need to master that, and you need to understand that properly before you go into this part 2, because in part 2, we're going to go over more of the advanced Wyckoff details. Okay? So that is also the main reason why I had a delay into releasing part 2, because I wanted you guys to implement part 1 for yourself first, kind of play around in the charts, look for some schematics yourself and how it developed, and kind of try to apply the rules that I've given in part 1. Because I don't want you guys to start focusing on these advanced details without understanding the basics first. Okay? So when you understand the basics and now you can learn the advanced details and you can apply them correctly, you'll become an absolute Wyckoff master. Okay? So what we're going to talk about in this advanced Wyckoff tutorial is, first we're going to go talking about distributions flowing over into accumulations and vice versa. We're going to talk about low time frame schematics going over into high time frame schematics. We're going to talk about Wyckoff within Wyckoff. We're going to talk about Wyckoff models flowing over into each other and why Wyckoff is absolutely everywhere. Okay? And even making this video today, I had a trade that was Wyckoff within Wyckoff. So I can even add that one to the example list, okay? Like, the examples are literally endless. So let's just get straight into it. I don't want to start yapping and waste your guys' time. Time is precious. So what we're going to talk about first is distributions flowing over into accumulations and vice versa. So let's imagine we have a distribution right here, okay? And all the tabs meet all the requirements. And you have your tab 1, you have your tab 2, and you have your tab 3 right here. And this is your distribution. Okay? What do I always tell you guys what the target of a distribution is? Let's say you found your short right in here. What is the target of a distribution? I always tell you guys the target of a distribution is its initial range low. But why do I tell you guys this? Well, the reason I'm telling you guys this is what happens if we start deviating the range low instead of breaking it. What if we start deviating it, right? And we're coming back inside. Well, at that moment in time, we could potentially have an accumulation where this is your tab 1, this is your tab 2, and let's say right here could be your tab 3, and then higher you go, right? If you do not break your range low and you start deviating it, this distribution could go over into an accumulation. That is why I always tell you that the technical target of a distribution is its initial range low. And it works the same the other way around, right? Let's say we have an accumulation schematic right here, and it's a 1, it's a model 1. Boom. We have our range here. Let's make this a bit deeper so it looks extra clean. There you go. We have our tab 1, we have our tab 2, we have our tab 3, each going lower, indicating a Wyckoff model 1 accumulation, and then we tab the range high. But from there, instead of breaking the range high, we come back inside and we start deviating it, and we create a possible distribution, right? The moment you start deviating it, this accumulation could go over into a distribution. So that is why I always aim for the opposite range extreme point, because at that moment in time, you don't know if the range is going to be broken towards the upside or it's going to start deviating it, right? And to figure out whether, the distribution will have follow through or not, that's where macro context plays a big role. Like, if you're macro bearish and you're coming into a POI that potentially has a lower high in the making on a macro scale, well, in that situation, this accumulation will most likely go over into distribution because we're expecting a lower high, right? We're expecting a lower high. But if we're expecting a higher low and we get the distribution, well, most likely it will go over into an accumulation. So context plays a big part whether, your distribution is going to have follow through or not, or if it's going to turn into accumulation or vice versa. So applying this in real time so it becomes a bit more clear for you guys, I want to talk about Bitcoin's price action, okay? As you can know, our structure from the low up is bullish, right? We're making higher lows and higher highs all the way up, okay? So what do you think is going to happen when price is right here? We have been uptrending aggressively. Price comes to an area of support. We had this nice little demand zone here, okay? Comes to an area of support. What do you think is going to happen? Obviously, expectational order flow at this time would be a higher low for a higher high. That will be your expectation until proven otherwise. So when we know that we're expecting a higher low in this area, let's zoom in to see exactly what happened here, okay? So we came into an area of significance where we are expecting a higher low for a higher high, okay? Well, coming into our little demand zone, right, we had bearish market structure. Until right here, this is where it broke back to bullish, having your break of structure right here. And for all the market structure rules, guys, again, Wyckoff tutorial part 1. We got the break of structure here. So what is expectational order flow after this break of structure? Obviously, it's a higher low for a higher high. And not just a higher low for a local higher high. No, we could potentially have a rotation all the way back up towards that main high following that string structure I just drew earlier. That was going like this. So macro context plays a big part because what happened, well, if we're going to zoom in on this bit of price action right here, right after our break, we formed a range on the 10-minute time frame, for example, and the 15-minute right here. This was our range. Okay, let's make it pretty. Go on the lower time frame, boom, our range points. Well, what do we see right here? We have our range high, we have our range low, and we have deviation 1 at the range highs, indicating a potential distribution in the making. Now, what happened is we grabbed extreme liquidity, making this a valid third tap, and then right here we broke structure back to bearish, indicating that this third tap is confirmed, the distribution is confirmed, and we're going to have a rotation back towards the range low right here. And that's exactly what happened. And you could have short scalped this for sure, right? This could have been an easy scalp trade. I cannot find my tool right now, but nice. You could have shorted the retest right here, put your stop above the high, and you target the low, and there you have your Wyckoff distribution trade. But do we think this Wyckoff distribution is going to have any follow through? No, because we're in an area where a higher low for a higher high makes sense on the higher time frame. So what happened is that price came into more demand right here, perfect tap of the start of your bigger range demand, and then from there we came back inside the range, okay? Indicating that this could turn into a potential accumulation, which is also what we were expecting, okay? So where is our extreme demand or extreme liquidity? Well, this is that last low prior to taking the main low, making it your extreme liquidity. And it's backed by this 1-minute bullish up candle that clearly shows that buyer stepped in there. So that would have been your extreme liquidity. Taps extreme demand, meets the requirement of a third tap, and then it breaks structure back to bullish. I'm going over faster about the accumulations now and distributions because that's already explained in part 1. But again, this is where your accumulation was confirmed. You could have entered on the break, stop loss below the low, and target the range high. Now, mind you, this target can be extended because we're in a macro uptrend and we're expecting price to go way higher. In general, we're expecting price to come all the way back up to that main high following your main market structure too, right? So if we see what happened from there is price started coming towards the targeted high. Let's accelerate the process right here. There you go. target hit. Okay, so not only does building a bigger context helps you into discovering if your distribution will have follow through or not, it can also increase your targets of your Wyckoffs, giving yourself a better percentage return. Because we had a distribution, but it went over into an accumulation because we were in a macro uptrend. Okay, so context plays a big role in that situation. Now, another example where it was the other way around is when we had the macro distribution. So from there, we took the high, but as I have discussed on many streams and videos, Bitcoin went into a massive distribution where this was your initial range high, initial range low, deviation 1, deviation 2, and we dumped down. Okay, right over here, we broke structure back to bearish, confirming a rotation all the way back down towards this range low. So any range formation, because price came down very aggressively, what can you expect after price came down aggressively? Some sort of consolidation, because price needs some more fuel before continuing down. So when you have an accumulation right here, obviously you're looking to trade the accumulation into a distribution because expectational order flow is price coming back towards the range low eventually, right? So if we follow structure from the top down, what can we see, right? Structure from the top down, we're making lower highs and lower lows. Right here, lower highs and lower lows. More like a 15-minute range. There you go. In a downtrend, let's get rid of this equilibrium. In this downtrend, you pull your range from bottom to top. There you go. And there is your range. So, again, range starting point, low and high, and then you get your deviation 1. Indicating signs of an accumulation. Let's put my bar replay tool right here. There you go. So, indicating signs of an accumulation. Now, right here we had this 2-minute demand zone. Basically this bullish up candle that took the low, indicating that buyer stepped in because see the price that came from it. And right here we tapped our extreme demand zone, indicating that this can be a valid third tap. Okay, where did we break market structure? Right here. So right here, you could have entered on the break, waited for the retest, and then you long this accumulation. Right here, you got the retest, even the reconfirmation here. But let's say you entered on the retest right here, stop below the low, and then you target the range high. Nice 4-hour risk to reward. Target hit. Beautiful accumulation. However, even though it's a beautiful accumulation, we're not expecting the accumulation to have follow through because expectational order flow is price tapping that macro range low. So when we tap the range high and we start deviating it after mitigating some supply here on the left, we can expect and we should be looking for a distribution. And guess what happened? We deviated the range low or range high, and that's extended now to the deviation high. There you go. And then you just missed it, right? You just missed it, grabbing extreme liquidity, indicating for a Model 2, and you enter on the confirmation of the break of structure, which was right here. You wicked it first, and then you broke it right here. So you could have shorted it all the way down on that break, stop loss below the low, and now, yes, you can target the range low, and you already have, or the new range low right here, and you can already have a 4.4 risk to reward, but we're expecting price to go lower because you can basically target this macro range low, which also eventually got mitigated right here. Obviously, it comes back up before touching it. There you go. So knowing our macro context, we know that an accumulation in this situation will most likely flow over into a distribution. And also, we can extend our distribution target now, increasing our risk to reward from 4 to 12. And it's basically just understanding your macro environment better. But know that accumulations can go over into distributions the same way the distribution here flew over or went over into accumulation. Okay, very common phenomenon that you guys need to be aware of. So understanding that, that's why you also know why I always have the opposite range point as my technical target, and based on the macro context, I extend that technical target or I don't. Okay? So that was our first point to discuss. Where is my text? There you go. So now we're going to go over into low time frame schematics, going over into high time frame schematics. MATIC and PEPE as the example. Okay, so what I mean with low time frame schematics going over into high time frame schematics. Let's say we have a range, and this is all on the 5-minute time frame, okay? Let's say we have a range that looks like this, and it's on the 5-minute time frame. Just like this. Okay? This is all on the 5-minute, okay? And you have your range high, you have your range low, you have deviation 1, you have deviation 2. It's all valid, you know, you get the distribution, and you can do it like this. You got the distribution, you got the trade, and it was a successful trade, okay? And this was on the 5-minute time frame. 5-minute time frame. And let's make that red so we know. What happens quite often, okay, what happens quite often is that this would be a 5-minute Wyckoff Model 1 distribution trade. That could be completely valid, and you could have made a banger of a trade. But what can happen is something like this. Okay? What can happen is something like I just drew out, and let's make that black. And if you stay on the 5-minute time frame, you will think that this is a 4-tap schematic, making it not a valid Wyckoff schematic. But what be the case that this range is not only valid on the 5-minute time frame, it's also valid on the 30-minute time frame. And on the 30-minute, this tap 2 and tap 3 just looks like one deviation because you don't have as much detail as on the 5 because you're on the higher time frame. So your 30-minute could look something like this. So in that situation, you just have tap 1, you ignore this one, this is just tap 2, and then this becomes tap 3. Okay? And that's why you always need to validate your range and see on which time frame your range is valid. And your range needs to be valid if you have that 6-candle rule, right? Where you have the 2 candles up, 2 candles down, 2 candles up again. Consecutive candles. Doesn't have to be consecutive candles from the exact starting points of the move, but in general, in this expansion, somewhere you need 2 consecutive candles pointing up. You need somewhere in this retracement 2 consecutive candles going down, and again in the expansion away, you need 2 consecutive candles going up. Same for this one, okay, to make it valid 30-minute structure. So this is just something what I would call a 5-minute time frame schematic going over into a 30-minute time frame schematic. And then that would be the equivalent of a low time frame schematic going over into a high time frame schematic, right? And this happens all the time. And sometimes your 5-minute time frame schematic doesn't even hit his target. And that's oftentimes the only losses we sometimes see. And that's because your low time frame schematic ended up going over into a high time frame schematic. And that can be the case if there was a reason to go higher than that initial point. Let's say there was a very good looking supply zone right here that you just missed on that low time frame schematic. That's when something like this can happen, where it goes over into a higher time frame schematic. And it's the exact same for an accumulation. Okay, exact same for an accumulation, where your lower time frame schematic can go over into a high time frame schematic, where this would just be demand. Okay, so let's apply that to MATIC. Let's apply that to MATIC, kind of remembering which example I was talking about. It happens literally all the time, but then sometimes when you have to explain it properly, you forget the example. But it came right here. Okay, let's talk about this. Boom. Okay. what happened right here? Okay. We were coming into an area of resistance, okay? And our market structure was pointing up. On the higher time frames, this is our market structure, okay? What do you do in an uptrend? In an uptrend, you pull your range from top to bottom, and then you get the following, right? You get the following right here. Boom. So you have your range starting point, and your range high, and your range low, and then you have deviation 1. I'm on the 10-minute time frame right now, okay? You have your deviation 1. Now, immediately bells should start ringing of, hey, this is a potential distribution. I'm going to watch for potential model 1 or a model 2. What did you get? You came up, deviated once more, indicating a Wyckoff model 1 distribution. You could have confirmed your entry right on this market structure break right here. Boom. On the 1 minute, it was a market structure break. There you go. And then you could have shorted the break, put your stop above the high, and then you target the range low. And that will have gotten mitigated right here. Or you took it as a front run and you got the TP right there. But valid trade. It ended up coming back, but that's something we're going to go over to when Wyckoff models flow over into each other. Okay? But we have a completely valid Wyckoff schematic on, let's call this the 10-minute time frame. A 10-minute time frame schematic. What happens from there is that we deviate the range low and we came back up. Okay? We deviate the range low and we came back up. Now, staying on the 10-minute, you would think like if we extend this range, you would think like we have some sort of 4 taps where this is 1, that's 2, that's 3, that's 4. Because on the 10-minute, that's all valid structure, right? This is all valid structure with the 6 candle rule. So it will be weird, right? It will be weird. But how can you still validate this Wyckoff? Well, if I go on the 30-minute time frame, or even if I go on the 45-minute time frame, and I had to draw my market structure using that 6 candle rule, right here we have market structure going up. We have 2 candles going up, 2 consecutive candles going up. Right here we have 2 consecutive candles going down, and then we don't have that right there. Let me. Oh, no. Okay. 2 consecutive candles going up, 2 consecutive, I can't even say that word. 2 consecutive candles going up, 2 consecutive candles going down, confirming this as a valid 45-minute range, okay? We can hover around the 30 and 45. Got the retracement, okay, of 2 consecutive candles going lower, and then we went higher again. So if I draw my market structure, okay, if I draw my market structure on the 45-minute, we have something like this, okay? In that situation, and also on the 30, it's okay. Really on the 45 only. If I'm on the 45, this deviation 2 and deviation 3 disappears. This totally disappears, and it's just one move up. So on the 45-minute time frame, this is a valid Wyckoff. And why did this tap, or why did price come higher once more after the local distribution right here, you know, where you had your 1, your 2, and your 3? Well, that's because it needed to mitigate that supply zone, okay? It's a perfect example right here. It needed to mitigate that supply zone. Oh. Getting rid of our drawings to make it more pretty. So knowing that it could be a low time frame schematic going over in a higher time frame schematic, now we just simply need to wait for another market structure break. And that's the break you got right there. So you could have shorted the same confirmation regarding a Wyckoff Model 1. Again, target the range low, right? And in this situation, this was at the macro POY, so you could have even extended your target, okay? But it just shows again that you could have shorted this move right here as this local distribution, and then you could have shorted this move again as the bigger distribution, the 1, the 2, the 3. And that's how a Wyckoff lower time frame schematic can go over into a higher time frame schematic. And we're also going to apply it to PEPE. And this is a question that I got, and I told this person that I would go over his situation on my Wyckoff tutorial part 2. Okay, so right here we have PEPE. Okay, and PEPE was trending down from the top, but locally we're trending up from the low up. Okay, so from the top we're trending down, from the low we're trending up. Okay, if I had to draw my most local market structure, let's just take a random point because I'm interested in this range, so it doesn't really matter what happened here. We're just going to take it from here. We have higher lows and higher highs. Okay, and I'm on the 1 hour now. Okay, I'm on the 1 hour and we have higher lows and higher highs. In an uptrend, you pull your range from top to bottom, just like this. There you go. And then you have tab 1, range high, range low. And then right here, you have deviation 1, and then you have deviation 2 all the way up here, indicating a Wyckoff Model 1 distribution. Okay? Indicating a Wyckoff Model 1 distribution. Now, when do you confirm the distribution? If you break market structure, there wasn't really that much market structure to wait for. Let's see. Yeah, maybe on the lower time frame, you got the break right here, right over there, and you shorted it, and then you put your stop loss above the high, and then you targeted the range low for a potential 3.5 risk to reward. Well, obviously, what happened is that you would have gotten stopped out. And if you stayed on the 1 hour time frame, you would think this is a macro 4 tap, and you would be confused, right? You would be confused. Obviously, guys, if you're in a distribution and you're wicking the low, like happened here, you're just wicking the low over and over again, please just put your stop loss to entry, because it clearly shows that price isn't able to go lower. Like, you're wicking the low. You want to have an easy sweep of these lows right here, okay? You don't want to wick the low over and over again because it shows signs of a potential reversal. So whenever that happens, just put your stop loss to entry, or you take a take profit. That's the equivalent of your stop loss size, and then you're also de-risked, okay? Little extra tip in the meantime. So if you stayed on the 1 hour time frame, you would think this is a 4 tap. This is not a valid Wyckoff schematic. But I'm telling you guys, always check your higher time frames, because if I go on the 4 hour, what happens to my market structure? If I go on the 4 hour and I have to draw market structure, I have a higher low and a higher high right here. And then this tab 1 and tab 2 completely disappears because this is not a valid pullback. This is just one move up. So on the 4 hour time frame, your higher time frame, yeah, this is just one move, and this would be your range low, and that would be your range high. And then these would be your starting points, right? These would be your starting points. So it's always important to check what the higher time frame is doing. And oftentimes on the lower time frame, you can have a valid Wyckoff schematic that actually hit its target, and then it goes over into a bigger one like here. But sometimes it happens that that lower time frame schematic never hits its target, and it goes over into a bigger time frame schematic, and you have to change your starting points of the range. Because right here, you had your 1, you had your 2, you had your 3. You know this is valid using 4 hour market structure, and 4 hour overrules the 1 hour. High time frame overrules the low time frame. So then it doesn't, it is not a 4 tap anymore. It's just a valid higher time frame schematic, right? And then you could have waited for the break of structure on the 1 minute right around here, entered on the break, and then you would have had a banger of a trade. Okay, stop loss above the high and target all the way towards the range low. Boom. For a nice 4.5 risk to reward. And this had the potential to run down further. And this is actually the Wyckoff that we also traded, right? But someone asked me, why is this not my starting point? In the beginning, that can be your starting point. But once price is here and it has developed more, I want you to zoom out and see what the highest time frame move is, and then be aware that you can take the high one more time, because most likely you wanted to grab more liquidity. You want to hit some supply up here before actually moving down, okay? So that's very key, okay? And sometimes you just have to take the loss. I rather lose 1% right here than miss out on 4% if it did play out, because you're losing 1% to afterwards make 4. That's a deal anyone should take, right? Lose 1, make 4. Make 3 in total. That's amazing. So that is low time frame schematics going over into high time frame schematics. Now, what's next? I think Wyckoff within Wyckoff. There you go. And I absolutely love this one because it kind of ties back into why Wyckoff is absolutely everywhere. Wyckoff within Wyckoff. And we're going to use it on PEPE. I can just apply. I can apply my trade from yesterday. PEPE, MATIC, and BTC. Oh, I immediately know what I'm talking about. Okay. Let's stay on PEPE because that's just where we left off. Let's exit replay mode and let's look at the trade I took yesterday. Okay. I explained this in literally the previous video. But we're going to go over it now, looking at it from a Wyckoff within Wyckoff perspective. Right here, we had our Wyckoff, and it was a valid Wyckoff on the 45, and we had our range high, and we had our range low, and we had deviation 1. Okay? Let's extend it. Right here, we had deviation 1, and then we had deviation 2, indicating that this could potentially be a Wyckoff Model 1 distribution. Okay? Let me check one more thing, guys. Let me check one more thing. Because I'm in the trade at the moment. So I have to manage this because I have to leave in a minute because I'm going on vacation. Okay. Okay. All good. Going back to PEPE. Right? And I can even use today's example. Oh, this is just... Oh, guys, this is just beautiful, okay? It's just beautiful. Now, we had the Model 1 on PEPE. What do I mean with Wyckoff within Wyckoff? It can totally happen that this is a valid Wyckoff Model 1 on the 45-minute, and that on a lower time frame, this tab 1 has its own little Wyckoff, or this tab 2 has its own little Wyckoff, or this tab 3 has its own little Wyckoff. That happens all the time. Literally, I traded one today, I traded one yesterday, and it happens all the time. So let's zoom in into that third tab and see what that third tab was looking like on a lower time frame. This is where we took the range high, and let's zoom in. Well, what can we see right here? Coming into that third tab high, we have market structure pointing up, right? Higher highs and higher lows. So in an uptrend, you pull your range from top to bottom, just like this. Pull your range from top to bottom. Range high, range low, deviation 1. This is not deviation 1, guys, because you never have a valid pullback. You have a 1 candle pullback, so it can never be deviation 1. A deviation needs to be valid structure. So that's your deviation 1. So it's deviation 1 of this local range while being your macro third tap high. Now, then what is extreme supply or extreme liquidity? Right here, you grab extreme liquidity. Let's even zoom in on the 1 out on the 1 minute. And then that's your third tap high. And then you wait for the market structure break back to bearish right here. And then now you can see that, guys, this high right here is your macro third tap high of the macro distribution. But locally, it's part of this Model 2 distribution. And the reason why this is so good to pay attention to is because if you traded the macro distribution only, the only way to confirm a trade on this macro distribution is if you break this low, because you need a market structure break back to bearish, right? Using this market structure tool. But if you have a local Wyckoff within it, you can already trade the local Wyckoff and get a better entry, which is exactly what we did yesterday. So let's say you entered on the break of this local distribution. You can even tighten up your target because this is now the invalidation. And you're already short in a 1% gain when you haven't even broken the main low yet. And then when you break the main low, that confirms that it's going all the way down to this range low. And that's how we nailed over 7% yesterday. And it's just absolutely amazing, right? Absolutely amazing. Wyckoff within Wyckoff, guys. It was a absolute beauty of a trade, okay? Absolute beauty of a trade. It took some time. It was testing the patience yesterday. There you go. Okay. So as you can see, you had the macro Wyckoff model 1, but the third tab of the macro distribution had its own little distribution. And this can happen on any time frame. You could have a 4-hour range that has a 30-minute Wyckoff in between, or you could have a 10-minute range that has a 1-minute Wyckoff in between, right? So that was the one of yesterday. Let's go to the one of today, guys. Let's go to the one of today. So in that case, I also don't need to do a post-trading analysis because it's already done for me, right? Did it grab that liquidity? Oh, it did grab the liquidity. Nice. Okay, so what we had today is Euro came into a macro supply zone. This was macro supply zone, and coming into it, we broke structure. So we broke structure coming into a macro supply zone. So what is expectational order flow after breaking structure? A lower high for a lower low. Okay, a lower high for a lower low. This was a nice little supply zone that I was watching. There you go. And then what happened? Well, from the top down, we're pulling our structure, right? From the top down, looking at what happened, we can clearly see that we had a range. So what do we do when market structure is pointing down? Because from the top down, market structure is pointing down. You have your range low, you have your range high, and you pull your range from bottom to top, okay? So this is, in that moment, your range. Now, I have the market sessions on. Okay, then you start deviating the range high, indicating for a potential distribution in the making, right? Range high, deviation, indicating for a potential distribution. I was already hoping that we would get a Model 1 distribution because we had this supply zone waiting above us to get mitigated. So what did price end up doing? We ended up deviating the high once more. If we extend it right here, we deviated it once more, and then we tapped in that supply zone. If I go on the 30-minute, you can clearly see this is one move, one move, one move, okay? This is not your third tap high because it never had a valid pullback, okay? If it broke structure, you could have traded it, but it never broke structure, never confirming it. And on the 30-minute, again, this is your distribution. So this is also where your local 15-minute Wyckoff goes over into like a 30 to 45-minute Wyckoff. Because on the 45-minute, this is like one up move. Now, obviously, we had the biggest trail of liquidity, which was like a very nice confluence to the trade. But if I only traded the Wyckoff on or as a macro model 1, I would have waited, or I would have needed to wait for my structure from the low up to break back to bearish. So our most local structure will look something like this: higher lows and higher highs coming into that supply zone. So that would be right here. That would be right there. Break of structure. But if we zoom in, again, if we zoom in at that third tap high, and let's extend our range a bit to the left right here. If we extend that range a bit to the left, you can see on a lower time frame that our third tap high was its own little distribution, right? It was its own little distribution where you have your range high, you have your range low, you extend it to the range high, and then this is extreme liquidity right here. So it meets the requirements of a potential Model 2 distribution, and then right here you get your break of structure, right? So where was my entry today? My entry was here, and I scaled in more when we broke that actual low, and then I targeted all the way down to this range low. And I made around 4% because I entered 50% here, entered 50% here, and there was a news event, and I was expecting price to go lower, but I always have to de-risk myself a little bit during news events. So that's also a little, post-trading analysis and Wyckoff tutorial in one. I can show you guys some proof because that's what I always like to do. I literally posted it right here. I posted it right here. Boom. Talking about this distribution, as you can see, literally this distribution of this being the manipulation phase. And then right here, I posted about this local model 2 distribution that you're seeing right there, right? And then I entered on the break. So absolutely lovely trade today. Again, another day, another Wyckoff, and another net gain of, I netted 4%. Yes, I netted 4% because I had to de-risk a little during the news event. But as you can see, again, a Wyckoff within a Wyckoff, where the Wyckoff right here helped you refine your entry, and even you could have already been short in a valid way without waiting for the main market structure low to break, because you're trading the local Wyckoff within the bigger Wyckoff. And the last example I want to go over into was Bitcoin, because it was the most obvious on Bitcoin. You could have had the best trade in your fucking life if you saw this video earlier and you knew these concepts and schematics sooner, okay? Because on a macro time frame, we had our range high and we had our range low, like I just discussed earlier, making this deviation 1 and making this deviation 2, indicating a macro Wyckoff model 1 distribution. But what happened, guys? Let's make it perfect. There you go. What happened at this third tap high? Well, if we zoom in, coming into that third tap high, you have bullish market structure, because the only way to go up is to have some sort of bullish market structure, right? And you had your range high and your range low. And then, yeah, deviation 1, right here, deviation 1, and you extend it to your deviation high right here. And then, yeah, deviation 2. Okay? So, again, this is not just the third tap of this local distribution. This is the third tap of a macro distribution, a 1, 2, and a 3. But your third tap has, again, its own little Wyckoff. So you could have already entered short right on this break. Okay, already entered short right on that break. Put your stop above the high. Don't even need to wait for this low to break. And then you had the biggest trade of your life, guys. Like, this was absolutely nuts. Could have targeted the range low. That's what I did. And then I cashed out most right around here because those were the weekend stops. That was my mistake. I've talked about that. I should have left it running. But yeah, massive trade. Absolute massive trade. Where, again, your third tap of your macro distribution. So this is your tap 1. Let's write it. This was your tap 1. This was your tap 2. And this is your tap 3. But the tap 3 had its own little Wyckoff that you could have traded. And again, that Wyckoff would have helped you refine your entry. There is one more example, but I think you guys get the point. Okay, I think you guys get the point. Nah. No, let's talk about that example, actually. No. Yeah. Okay. Let's talk about that example, because I'm gonna be giving you guys I'm gonna test you guys on this one. Okay, I have one more example on MATIC, which happened yesterday. Okay, happened yesterday. Where is the price action? There you go. Okay. If you have to look at this, okay? If you have to look at this, and this is your range, where do you see the Wyckoff within Wyckoff? Where do you see the Wyckoff within Wyckoff? This is your range high. This is your range low. You can pause the video to test yourself real quick. Where do you see Wyckoff within Wyckoff in this trade? So, if you've paused the video or you're back now, what we can see is that this was our range high, this was our range low, and this is deviation 1. And this is deviation 2. Okay? Indicating a Wyckoff model 1 distribution. But if we zoom in, guys, we have an uptrend. Higher lows and higher highs. So this itself is a local range. This itself is a local range, right? Oh. Where you have your range high and you have your range low. And then that makes this its own little Wyckoff within the bigger Wyckoff. And that way you can already confirm an entry here. It's kind of a double Wyckoff because the entry is the same if you've traded as a model 1 and then you targeted the range low, right? But again, you can see a Wyckoff within a bigger Wyckoff schematic, and then price ended up coming back for the last supply zone, and you dump down from there because once you break this low right here, that confirms, once you break the low right here, that confirms the price is going to come back towards the range low. Okay? So again, little trick, Wyckoff within Wyckoff can be very effective to refine your entries for double confluences, you know, and important to understand. Okay? So deleting this. Back to Bitcoin. Where is my text? Where is my map? Wyckoff models flowing over into each other. And we're going to talk about Ethereum as a prime example from yesterday. Okay, so I got a lot of questions of people asking me why I have put my range in this schematic from here and not from here. Because if you pull your range as these starting points, you will have a model 1. And if you pull your range from this starting point, you would have a model 2. Right? So, both are correct. Right? Both are correct. Because if we're, let's say, on the 30-minute time frame, you know from the low up, you have an uptrend of higher lows and higher highs, and then you have this. Making this your range starting point. Okay? Making this your range starting point. Range high, range low, and this is completely valid. I'm proud for everyone that noticed this, okay? Completely valid. Then with this would be your deviation numero uno, and this would be your deviation numero tres, okay? Since I'm in Spain right now, beautiful. Let's check if everything is going correctly. There you go, okay. Making this your model 1. Let's extend it, there you go. Okay. This is totally valid, guys. This is 100% valid. But guess what? We pumped so hard into that third tap high. There was no structure in this whole move up to confirm an entry on a lower time frame, like 0. There was no structure here. It was one pump. And as you guys know, you have to break market structure from the low between tap 2 and tap 3 towards the third tap high to confirm your model 1 distribution. But you didn't get that, right? You didn't get that. So because of that, you could have never traded this model 1 because there was no confirmation. And what happens then is we came down, let's extend it. We came down leaving a trail of liquidity behind, okay? Massive trail of liquidity. Where this is your starting point of that liquidity trail, making this your extreme liquidity grab, okay? And as you guys know, or as you guys at least should know by now, if you want to trade a third tap of a Wyckoff Model 2, it needs to either grab extreme liquidity or hit extreme supply for Model 2 distribution, right? And look what happens right here. That is exactly what happens. You broke structure right here, which is your market structure from the low up. And then you could have easily shorted it right here. Stop loss above that third tap high and then target the low. Now, both are correct because if you've used the tap 1 as this, that would make this your range low, giving yourself a bigger target. The thing is, the reason why I put it like this is because my Model 1 never got confirmed. Like the Model 1 never got confirmed because you never broke structure, and you will never break structure because it's just one pump candle. And this tap meets all the requirements for a tap 3 of a Model 2. That's why I looked at it as a Model 2. But in general, this is something what I call Wyckoff models flowing over into each other, where a Model 1 flows over into a Model 2. And that happens quite often, okay? That happens quite often where, you know, your Model 1 just doesn't hit its target, comes back up, and then for that lower high. And that's kind of a way of looking at it of a Model 1 going over into a Model 2. And then you can trade it again or add more, trailing your stop loss down. And you can trade it as a Model 2 instead of a Model 1. But this is a prime example of a Model 1 flowing over into a Model 2. okay? And sometimes you have that a model 2 flows over into a model 1 where you go higher one more time. So let's say this point didn't exist, okay? Let's say that point didn't exist. Price came down and just came up one more time. Sometimes that happens where this is your 1, this is your 1, this is your 2, and that's your 3, okay? Or, sorry, this would be your new 3. And that's a situation where, you know, you have to take the L to get the W, okay? And again, this is something that happens when you have supply or liquidity remaining above you, just like described in the low time frame schematics going over into the high time frame schematics. I had another one. Gold on the macro time frame. Yeah, this is a perfect example of my gold short, okay? Perfect example of my macro gold short. Because on a macro time frame, right? On a macro time frame, what can we see on the daily? Well, in the daily, we're in an uptrend, right? So from the daily, we're in an uptrend, meaning you pull your range from top to bottom. Because again, Wyckoff works on any time frame, guys. Range high, range low, deviation 1, deviation 2, indicating a Wyckoff Model 1 distribution. But what happened is that instead of having an easy rotation down towards the range low, which is the target of the Wyckoff Model 1 distribution, we came back up all the way to extreme supply. Like this was your last supply remaining, like literally your last supply remaining. Price came into it and got this aggressive sell order where we got our short right around here. So you can still call the Model 1, you know, that just has a lower high, but this would be a prime example because this tap meets all the requirement of a Model 2 third tap distribution, and that's why I call it that this is a Model 1 going over into a Model 2. And when you have that, you get these nice tops that are rounding off, right? They're rounding off, and that's exactly what you want to see for a good macro top. So we're getting some pullback here, but I am aiming for literally the range low. So let's see if we can eventually get there prior to taking that high right here. Okay. But again, prime example of a Model 1 going over into a Model 2. And it works the other way around as well. You can have a Model 2 going over into a Model 1. And obviously, it can also be just from the accumulation perspective, right? So be aware of that. That sometimes you're trading your Model 2 distribution. Okay. Let's draw it. Sometimes you'll be trading your Model 2 distribution just like this. So, range high, range low, tab 2, tab 3, it's all valid, but you just missed this supply zone. You just missed this supply zone. And instead of hitting your target, it does something like this. Just accept it. It's just a Model 2 that went over into a Model 1. Okay? Just accept it. You have sometimes to take the L right here to get the W right there. Okay? But it's very common when this happens if you have something really good looking waiting above you, whether it's like a supply zone or something liquidity related. Okay, so hope that is explained well. And then lastly, we have why Wyckoff is absolutely everywhere. Okay, guys, it is everywhere. So let's just look at Bitcoin's local price action. Okay, why is Wyckoff absolutely everywhere? Well, we have already discussed that we had a Wyckoff here, we had a Wyckoff here, you had a Wyckoff here, you had a Wyckoff here, you had a Wyckoff there. We went over all of these. This was from the beginning of the distribution flowing over into accumulations. There was Wyckoff and Wyckoff, and this is, again, accumulation going over into distribution. Then we had a Wyckoff here. Then we had a Wyckoff here. Then we had a Wyckoff. Okay, that was the last Wyckoff. Okay, so just in a span of 9 days, on the mid time frame alone, literally on the mid time frame alone, yeah, 1, 2, 3, 4, 5, 6, 7. That's almost a Wyckoff a day, where the Wyckoff netted you almost over 60% in this entire range. I made a tweet about that. But not only looking at it like that, let's look at this most local price action, like actually local, okay? And let's go on a lower time frame for this. Well, what you can see is on a lower time frame, price trends up, range high, range low, deviation 1, deviation 2, model 2, right here, 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3, 1, 2, 3. And this is probably something that went over in a higher time frame schematic. And right here, you can see 1, 2, 3. Distribution going over into accumulation. Right here. 1, 2, 3. 1, 2, 3. Right here. 1, 2, 3. And then that's what we're here today. Guys, I'm only on the 3 minutes. I'm only on the 3 minutes. And look at all these Wyckoff schematics. Now, mind you, if we zoom in into a Wyckoff schematic like this one, for example, let's zoom in right here. Maybe it wasn't tradable because it's such a low time frame. Here, exactly. So this was a range, right? Maybe this wasn't tradable because you had your tap 1, you had your tap 2, you had your tap 3, okay? But you never had any market structure break back to bullish because we're already on the 1 minute. Maybe on the 15-second we had one. Let's check. Yeah, on the 15-second you had a structure break back to bullish right here. And that's why you can scalp it as well on the second time frame. But by the way, that's not something I suggest you guys start doing. That's something you only do when you're absolutely mastered Wyckoff and you know exactly where price is heading towards, and you just have to find confirmations, okay? So don't start using the 15-second time frame as a beginner. Stay on the mid time frame schematics because those are the highest probability ones. But I'm just showing you guys that it's everywhere, okay? But it doesn't have to be tradable every single time. We only catch the ones that we trade. I have around a trade a day, right? I have around a trade a day. Like probably maybe this was tradable. Let's see. You're trending locally. You're trending down. You have your 1. You have your 2. You have your 3. Well, look, this one was tradable. Right here, you have your structure break back to bullish. You can enter on the retest right here on this candle. Put your stop below the low. And you can target the high for a nice 1.5 risk to reward. Mind you guys, this is a trade that took exactly 4 minutes. A trade that took exactly 4 minutes, guys. And you make 1.5%. I just made a tweet talking about if you made 10% a week consistently, 10% a week, this is 1.5% in 4 minutes. If you made 1% or 10% a week consistently, your account would grow from 1K to 142K in only 1 year, okay? In only 1 year. But when you know that structure can be trending up, right? Structure can be trending up like this on the higher time frame. I'm going to extend it. Structure could be trending up on the high time frame like this. Then on the mid time frame, it could be trending down. And then trending up. And then trending down again. Just like this. So let's make this red. Your main market structure could be trending up. Well, the only way to get from point A to point B and from point C to point D and from point D to point A, you need to have your red structure drawing. To get from point A to B, you need to have some sort of bearish structure, and that will be your red structure. The same way to get from point B to C, you need some upward structure. That will be your red structure. So when you know that, and then you also know that within these tiny moves, guys, within all these tiny moves, you also have structure. Just like this. Let's make that purple or make that blue. Once you know that in every little point, right, in every little point, you need, I cannot stand it's ugly. In every little retracement, you figure out that you also have some structure as shown in the blue one. What you can do in that situation, if if you only look at your black structure drawing, you're in an uptrend. So you can pull your range from top to bottom, right? That would be your range using black structure drawing only. Only look at the black structure drawing, guys, okay? Only look at the black one. This will be your range high. That will be your range low. Boom. Potential Wyckoff range, okay? But now that you know, let's ignore that one. Now let's look at our red structure drawing. You know, red structure drawing is pointing down. So every little retracement here could be a new Wyckoff range, right? Where this, in a downtrend, you pull your range from bottom to top. This could all be a little Wyckoff because it's all a range if it's confirmed, right? Like I drew right here. And now that you know, let's ignore the red structure drawing. Now that you know that to get from point A to point B in this red drawing to these dots, you need some form of bullish structure and bearish structure. You can, in the bullish structure, pull your range again from top to bottom, and then in your bearish structure again from bottom to top. So you can find so much Wyckoff in one area in the chart because you have all these different types of market structure pools. And it's absolutely nuts. It's absolutely nuts. So if we... Let's keep it on the chart. Let's keep it on the chart. If we apply this exactly to this Bitcoin price action, right? Where is it? Okay, I don't know where it went. Oh, maybe on the lower time frame here? Oh, yeah, it's on the lower time frame. Okay, damn, I didn't know I drew it that low. Okay, let's see. Cancel replay mode. Let's check this. There you go. Let's zoom in here. Let's make a picture of it. Let's copy and paste this picture. Delete all this. Boom. Boom. Now that we know that this could be happening, okay, let's look at it from the color perspective. Okay, let's do the 45. Well, this is our 45 structure, right? Higher highs and higher lows. Boom. This was a little breakdown, and then you still went higher. Let's keep this as our black structure drawing. That could be your black structure drawing, right? Okay, keep that right in our minds. Now, if we look at the red ones, we can go maybe the 5 minute, okay? And we can see that on the 5 minute, in all these moves, you have these local downwards moves. And then you have these local upwards moves. And again, local down moves. And then again, local up moves. Boom. Boom. And I'm not like being very strict right now. I'm just showing you what's going on. So you see that, you know, our black structure drawing is looking like this on the higher time frame. Now on the 5 minute, our black structure can be divided into our red structure. And now on even a lower time frame, our red structure can be divided into our blue structure, where this little move down has also Wyckoff, right? Let's make it blue. Boom. And this little move up also has structure. And this little move down also has structure, right? And I can continue, guys. I can continue, right? Where this red drawing down, this move down also has structure. Little upward structure, little downward structure again. Like, you can apply structure over structure. And when you just look at any structure, you can immediately, at every range or at every structure pool, you can pull a range either from the top to bottom or from bottom to top, right? And trust me, you will find the highest time frame Wyckoff or the highest probability Wyckoff schematics if you stick to like your red structure as a minimum, your mid time frame structure. Because the lower you get using structure, the higher risk it becomes. But I want to open your guys' mind to the possibility because I knew someone asked me, hey, I'm searching endlessly for a Wyckoff schematic. Oh, guys, I can already tell you 50 Wyckoff schematics on the 15-second time frame that was in here. But we don't want those. We only want the high probability ones, okay? We only want the high probability ones. So Bitcoin is pumping. We love to see it. I wonder, who told you guys you were going to go up from here? But what? Oh, let's to wrap it up for you guys. If we look at this range on the daily time frame, okay? If we look at this range on the daily time frame, what does Wyckoff look like? Range high, range low on the daily time frame. Deviation 1, deviation 2, okay? This was your Wyckoff schematic on the daily time frame. But then it failed. It came down one more time, okay? It came down one more time. Why? Maybe it wanted to grab more liquidity. We knew that there was demand right here. This was a very important demand zone. That's exactly what we just mitigated. But price came down one more time. Now, on the daily time frame, this may look like a low time frame scheme, or on the daily time frame, this might look like a 4-tap, okay? But if I go on the 3-day, this is what our structure looks like. On the 3-day, this is not valid structure. It's only 2 up candles, and then that's it. No 2 consecutive down candles. So on the 3-day, this is what your structure looks like. That's why I said this daily schematic could go over into this 3-day schematic. But what happened? We came down one more time, okay? So then if we go on the weekly, we realize that, hey, on the weekly time frame, if I have to pull my structure, you just have one move down, one move up, 2 candles down, 2 candles up, 2 candles down, 2 candles up, candle going down again. And you don't know if this is going to be a down candle or not. But on the weekly time frame, this could be your schematic. Now, this would be low time frame going over into high time frame, going over into higher time frame. And that's something that I don't see happening that often. So that's why I gave this possibility like a 5 to 10% chance of happening, but it's exactly what happened. And then you have to ask yourself, with the reasoning I just gave before, going over low time frame schematics, going over into high time frame schematics, of why would this happen? Well, every single deviation prior to this final deviation right here did not mitigate demand. And right now, we mitigated demand. So price had a reason every single time to come lower. But now, price has no reason anymore. Price has no reason to go lower. Okay? No reason. Because we mitigated demand and we grabbed all extreme liquidity and we had the worst sentiment that we can get. So that's it for me, guys. Listen closely, okay? If you appreciated this video, because it takes time for me to make these videos. I need to prepare. I need to record them. Also, all the post-trading analysis videos and the Wyckoff parts. Like, I'm doing it for you guys. I'm not asking anything from you regarding money, regarding, subscriptions or whatsoever. No. I want you guys to succeed, okay? Giving is the biggest fulfillment a human can get. And I want all of you guys to succeed with me. But, if you want to support me, just like my posts on Twitter, comment under my post. It helps the algorithm. If you trade a certain Wyckoff schematic because of me, because I helped you open your eyes to Wyckoff schematics, keep on tagging me. Literally, keep on tagging me. I will never get annoyed if you guys keep on tagging me in your Wyckoff setups, because I am teaching you guys this to see you guys succeed. So if you take a Wyckoff trade and it works, even if it doesn't work, tag me, because then I can see that you guys are learning and are succeeding, and that's the fulfillment that I'm aiming for, okay? That's the fulfillment that I'm aiming for. I'm also working on building a community, okay? I'm working on servers, building a community, and, creating a group of just Wyckoff traders that are going to be unstoppable. You name a prop firm, and we just absolutely destroy that prop firm, becoming too profitable, getting banned. I want to start a cult, a community, and I want you guys to be a part of it. So if you appreciate this video, leave a like under this video, but mainly on Twitter, just support me on Twitter, man. Comment under my post. I only want to provide high value content for you guys, and I love every single one of you. You are all going to make it. watch this video a few more times, let the information all sink in, and then try and apply it. Kind of play around in the charts for yourself. See if you can spot any Wyckoffs and Wyckoffs, or maybe the losses that you have taken so far can be explained using the advanced details I have just given to you guys. And I'm going on vacation. I'll be back August 13th with a post-trading analysis video, or just a normal video if I didn't take a trade in the meantime. And I'll see you guys in 5 days. Love you guys. Peace.